Government revises economic statistics once a year. It's in the fall. I've never talked about it before, but they just did, and it was off the charts to the upside. So whatever you thought about the economy 6 weeks ago, looking at those numbers, you have to feel a little more constructive on the economy today.
On WealthTrack, veteran money manager and strategist Bob Dahl on the economy, market strategy, and yes, politics.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategist Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. By just about any measure, the U.S. stock market looks expensive. In the "a picture is worth 1,000 words" school of thought, we have two charts courtesy of research firm Strategist to illustrate the point. First, take a look at the widely followed CAPE ratio, which measures the S&P 500 cyclically adjusted price-to-earnings ratio over 10-year periods. It's currently in the 30s, still lower than it was at the height of the tech bubble, but it's up there. Then there's the S&P's valuation as a percentage of U.S. GDP. The stock market is being valued at 168% of the total value of the U.S. economy, much higher than during the tech bubble. As Strategist points out, that leaves little room for error. What to make of these lofty valuations? Do they require any action on the part of investors? Joining us is one of our longtime favorite guests who has been on WealthTrack since the very beginning. He is Robert Dahl, CEO, President, and Chief Investment Officer of Crossmark Global Investments, a faith-based investment management firm with more than $7 billion under management. Dahl is also portfolio manager for the firm's multiple U.S. large-cap equity strategies, including the firm's three steward large-cap mutual funds, Core, Growth, and Value. Dahl has had similar management and portfolio responsibilities at major investment firms, including Merrill Lynch, BlackRock, and Oppenheimer funds. He is also famous for his frequently accurate list of 10 annual predictions forecasting market, economic, interest rate, and political trends, among others. So I began the interview with an obvious question. As a longtime money manager, how much attention does he pay to presidential elections?
Well, Consuelo, elections matter. You know that. But they matter over time as policy is unwound or discovered or passed. The problem is so many people get so preoccupied. They bite their fingernails. They stop doing everything. They can't invest, of course, because we don't know the outcome. It rarely matters that much. Like historically, when we get unified government, the same party in the presidency, the House, and the Senate, markets often struggle because there's a concern that the extreme things will get done. Markets typically prefer divided government. So if we get some combination of Republican and Democrat across the three branches, the market probably breathes a sigh of relief. We'll see how it comes out.
From a strategist point of view, leading up to an election, do you do anything differently than you would otherwise?
Not a whole lot. It's more about the economy and earnings. They're the things that drive what we do in our portfolios, Consuelo, as you know.
So let's talk about the outlook for the economy. Bob Dahl, what are you telling clients? What is your view of the economy?
So the economy's in pretty good shape. Better than many of us who are a little more cautious coming into the year thought. As a result of Americans having a lot of cash on their balance sheets to spend, both at high and low income levels. We've had pretty aggressive policy on the fiscal side, a lot of deficit spending. All that's kept the economy going. But of late, we started to see inventories pick up a little bit. Low-end consumers are struggling. Middle-income consumers beginning to fray a little bit. So I think we'll get some economic weakness into the turn of the year. But to repeat, the economy's been better than most people thought.
How expensive do you think the stock market is? And when I talk about the stock market, I'm referring to the S&P 500, which basically is the place you, as a large cap equity manager, that's your playground.
Yeah, the simple answer is very expensive. We just talked about the economy, how it's in pretty good shape. it better be in good shape. At these valuation levels, the market's saying the world better be nearly perfect. The Fed's going to continue to bring inflation down, economic growth is going to stay strong, earnings growth is going to be robust, and it's off to fairy tale land. If the world's not perfect, it's unlikely the market does better, but the alternatives are a little bit worse. So I'm cautious, fully invested, but cautious. We're in a momentum-driven bull market, Consuelo. Bull market means path of least resistance is up. The momentum part obviously suggests that buying begets buying. If you're buying something and I hear about it, I better buy it too before I miss it. That sort of thing. And again, at these high valuation levels, it's expecting the world's going to be really good. And as you know, consensus earnings expectations for this year, 2025 and 2026 are all double digits. The United States has never had 3 double-digit earnings growth years in a row unless we've come out of recession. So I'm dubious those numbers can be achieved.
What do you do in a situation like that? Because I read in your Doll's Deliberations, your weekly missive to clients, which I love. So high risk, momentum driven bull market. High risk.
The high risk part is the valuation that we've been speaking about. And I've learned sometimes the hard way over these many years, predicting the end of a momentum-driven bull market, Consuelo, is a fool's game. There are no signals to say when that's going to end. So you need to be invested, but you can be really careful what you own. You've probably heard me say it before. I want to own companies that have strong earnings predictability, strong earnings persistence, and good positive free cash flow generation with hopefully acceleration there. You put those things together, in some sense it's a quality list of names. Those names have done just fine on the way up, and if we get any kind of selling squall, I think they will go down less than the market overall.
How divorced is the momentum that you're seeing in the market from the reality? I mean, you were just talking about, double-digit earnings growth.
Well, at these valuation levels, we better have 3 years of double-digit earnings growth. In other words,
Right.
The market's expecting all the rosy things we just talked about to come true. And if they do, the market's probably where it deserves to be. The problem is alternative scenarios. I can't find one that's better. I can't tell you that PEs are going from mid-20s up toward 30. I just can't do that. And the other way for stocks to go up, of course, their earnings are better than expected. And we just said they're pretty stretched in expectation already. So I come back to that's the high risk part of this. Doesn't mean it can't go up. It's been going up and it continues until it doesn't anymore. And that's a tough way to invest.
So the earnings estimates, do you think that they are inflated, that they are over optimistic? What are your earnings estimate expectations?
Let's take the third quarter earnings, which are still in the process of being released. They're coming in reasonably good, but in the last 4 weeks, we've seen revisions as follows. 43% of the revisions have been up, 57% have been down.
Wow.
I don't like that mix in an environment where we have these very high valuation levels. So expectations are very high to repeat and are hard to sustain and to meet.
What would you advise individual investors who don't have to be, as you are, in a mutual fund fully invested?
Yeah, well, a lot of my mutual fund competitors do raise cash, and we'll get defensive, hopefully at the right time, lower the beta in the portfolio, lower the economic sensitivity. So to the individual investor, you got to own some stocks. I'm not saying don't be there, but if you've got some big gains, on big up days, let a little bit go. It's okay. Bonds have backed up. The yields have backed up 60 basis points, more than 0.5% just in the last 6 weeks on the back of this.
Backed up means that the rates have gone up.
Correct. So they've gone up, bond prices have come down, and that's a function of the economy is doing well, and the probability that President Trump wins has gone up in the odds makers market. So both of those are causing interest rates to move up some, creating a bond market that's a little more attractive, a 4.5%. 10-year Treasury, 4.25%. I'd be nibbling away at that sort of thing. And let me answer the question yet another way. I think 5 years from now, there'll be a lot of individuals, a lot of financial advisors who say, why didn't I have more alternatives in my portfolio? Because given the starting point of valuations and earnings, as we just discussed, really hard to see stocks getting a double-digit rate of return compound over the next 5 years. It might be half that. Doesn't mean we can't make money. It's just going to be a lot harder. So have some other things in your portfolio, an equity market neutral fund, some real estate, some private equity, if that fits what you're able to do.
So let me ask you about private equity, because by some estimates, private equity is really overvalued as well. It's done extremely well, as you know.
It's not cheap, and you're right. A lot of people have thrown a lot of money in that direction. In fact, you see a lot of private equity products that have a lot of cash because the managers don't know quite where to put the money. So I'm not discounting that there's some risk there as well. You got to have a long-term view, as often you're required to have the long-term view, the lack of liquidity in many of those private equity vehicles.
So let me get back to the economy, which has done better than you had anticipated. What are you seeing in the economy that is convincing you, number one, that there's strength, but also where are you seeing vulnerability?
Yeah, the strength is coming from the fact that people are still buying services, if you will. Mm-hmm. That mm-hmm. is, having bought goods early on after the pandemic, they have all the things they need. Now they want to have experiences. So let me go out to eat. Let me go on a vacation. And those things are still in pretty good demand as the consumers had all that cash, as I pointed out, and they're using it to buy those sorts of things. It's an election year, and when election years come, you always see the government wanting to get reelected, spending a lot of money. And that's also primed the pump for good economic growth. And to repeat, that's continued. I might, as a footnote, say I never talk about revisions. Government revises economic statistics once a year. It's in the fall. I've never talked about it before, but they just did, and it was off the charts to the upside. So whatever you thought about the economy 6 weeks ago, looking at those numbers, you have to feel a little more constructive on the economy today.
But there's also record levels of credit card debt right
yes.
now, and that some banks have been sounding the alarm about, defaults still relatively low, but rising. So how concerned are you about the financial shape of the consumer?
Certainly concerned, as I hinted earlier. High-end consumers tend to do well through thick and thin, so leave them to the side. Low-end consumers have been struggling for arguably a couple of years. Their wage increases have not kept up with price increases, so they're struggling. But now, if you look at, for example, the University of Michigan Consumer Survey comes out monthly, middle-income consumers, which are the vast majority of Americans, are beginning to struggle. They're spending their money. As you point out, you're starting to see them take credit card balances up so they can spend. And sadly, there's even some evidence of some 401k rating. That's not sustainable and not real healthy. So I think consumers are getting a little strung out, and therefore the economic weakness sometime in the future is our view.
Your view of the Fed?
I would argue that the Fed is, as they say, data dependent, and the data is all over the place, which to some degree means the Fed's all over the place. We know they were very late in beginning to raise rates. When you throw too much money at too few goods, the definition of inflation, post the pandemic, it's no surprise that we had an inflation. They began recently to start raising rates. And now the economy and the inflation numbers suggest, well, did they go too far too fast? So I think if you're only data dependent and don't have a plan, you're going to be buffeted in every direction with economic statistics. So at a 4 3/4 Fed funds rate, that's pretty high relative to the other things going on in the economy. So my guess is they'll lower rates a bit more, but not nearly as much as the futures curve are suggesting through the end of 2025.
You mentioned that you're looking for companies, quality companies. Looking at your Steward Large Cap Core Fund, for instance, which you've got a core, you've got a growth, and you've got a value fund. But when I'm looking at your top holdings, I mean Microsoft, Apple, Nvidia, Alphabet, Amazon. So those are the Magnificent Seven, or whatever you want to call them. They are still, in your mind, worth having very large positions in. Do those meet your criteria of high quality companies, free cash flow, whatever?
Generally speaking, yes. They've gotten more expensive. And what, of course, when you look at those, you see them as the largest holdings, but many of them are in an underweight position versus the benchmark. So if I had a neutral view or a positive view, I would have even more of those names in the portfolio. So it's been an area of the market that is obviously dominated, and so their weightings and all the benchmarks have gone up. And if you want to keep even, you've got to be a benchmark weight at least. And in too many of them for the calendar year 2024, I've had not enough. I've been below the market, even though they're the top holdings. But yes, they do have many of those characteristics that we look for. I wish their valuation was a little more interesting.
What about, the Visas and MasterCard? I'm just reading from the list, Bob, at least the one that I have. I think it's as of the middle of the year. And Home Depot and Salesforce, Intuit. Again, those are among your top 10 holdings.
Generally speaking, positive. Obviously, they wouldn't be in top holdings if they weren't, but we're constructive on them both here in the near term and think over time they will do well. They have those characteristics: reasonably high earnings persistence, earnings predictability, and a lot of them have very strong cash flow.
Large cap equity. You have been managing large cap equity, U.S. equities, for decades. It has been the sweet spot for investors, no question about it. Is there any other area of the market, obviously mid cap, small cap, that you think has been neglected that you would want to put some money into, or is large cap U.S. equity still the place to be as far as you're concerned?
You need some of that large cap. It is the dominant place in the world, frankly, for economic activity and economic growth. But I see way too many portfolios of U.S. investors, individuals, institutions, that are kind of 98, 99, some 100% in the U.S. And I say, stand up, take a bow, you've been exactly the right place. And tomorrow morning, when nobody's looking, begin a dollar cost averaging program and buy some international stocks or some global portfolios. Do invest, if you're all in growth, put some value in the portfolio. This is probably a good time to get a little more diversification, given that the asset class you've talked about has done so well.
Earnings kind of determine stock prices mostly, right? So that still is the case.
Absolutely.
So when you look at the earnings of the large cap U.S. equities versus other markets, they should be doing much better. I mean, they should be outperforming because they are outperforming as far as revenues growth and earnings growth.
I agree with all that, and that's why I'm not saying sell them. I'm saying diversify a bit.
I mentioned you've got a large cap growth fund, and you've also got a large cap value fund. Picking a favorite child, and I'm looking at your value portfolio with J.P. Morgan Chase and Berkshire Hathaway, Bank of America, Cisco, Verizon, IBM, AT&T, Citigroup, Coca-Cola, Elevance Health.
So I'll start with a diplomatic answer. I want some growth and some value in my portfolio.
All right.
But on the growth side, I'm going to be really stingy about how much I pay because a lot of them are expensive. On the value side, I don't just want cheap stocks. I want cheap stocks that have some kind of catalyst that's going to enable them to do well. Now, if you put a gun to my head, which you sort of do with your question, if I could only own one for the next 12 to 36 months, I'd lean to the value side. They've been neglected. They're a whole lot cheaper than the growth stocks, and I think they're due for a comeback. And they've done a bit better. Value beat growth, for example, in the third quarter, calendar quarter of this year. Probably more of that to come.
And of course, that is a refrain that we have heard for many, many years as value has continued to underperform growth. But why now?
Yeah, it's a function of the valuation difference between growth and value. It's a function of the fact that when economic growth is okay, which it is now, that's often when the value stocks come to life. And take the financials and the banks in particular. Financials, the biggest weighting in the value benchmarks. The banks are interesting. A lot of the lending took place outside the banking system this cycle, Consuelo, as you know, and therefore the assets on those balance sheets probably are higher quality than usual. They're certainly very cheap. We've gotten financials are early in reporting, and the third quarter earnings for banks were pretty good.
Valuations in the growth sector, again, the mega cap 7, is that where you think that the market is most vulnerable?
It's broader than that. It's outside the Magnificent Seven. The PE ratios, the valuations are lower, no question about it, but they're still not cheap. The Magnificent Seven, most of them have done well because they've produced the earnings and the cash flow.
Yeah.
So no mystery there. So I'm not saying get out of those. You see them in my growth portfolio, albeit some of them at an underweight versus the benchmark.
So when you talk to your clients, Bob, and you're balancing this picture between, again, very strong earnings growth and certainly earnings expectations, even though they are being revised downward now, which is pretty big news. What are you telling them, the risk reward in the market? How do you assess that for them?
You know, we say, we come back to the definition of the market we think we're in. High risk, momentum driven bull market. Bull means up, path of least resistance. Momentum driven means too many people are buying stocks because their neighbors are buying them. That means we have some stocks and some weak hands. And the high risk comes back to the valuation. So if people want to take a few chips off the table, as we go to high valuation levels and buy a bond or two, maybe have a little cash on the sidelines, earning 5-ish%, that's not all bad.
And what about the economy? Where do you see the vulnerability in the economy?
I come back to what we talked about, the consumer. I wasn't concerned as the low end began to struggle, but the middle income consumers, that's the vast majority of us. And if they're beginning to struggle, the economy probably weakens somewhat. I mentioned inventories. There are a lot of inventory levels that are pretty high. That means we've had good growth from building those inventories. If they don't get sold, the demand's going to come down somewhat. Labor market is fraying a bit. There are statistics that show that people are working part-time that want to find a full-time job or struggling to do so. I mentioned earlier for low-end consumers and mid, some of the same. My income has not gone up as much as prices have, so that erodes my pricing power, and that eventually weighs on the economy. We've seen in some of the labor strikes demands for very high rates of return. I mean, the Boeing second vote by the union turned down on a pretty hefty increase over the next 4 years in wages. We'll see how that all shakes out.
Inflation outlook, I mean, given the fact that, as you just mentioned, I mean, we've had some very rich labor contracts recently. Deglobalization is happening. I mean, we're talking about possibly higher tariffs. Those are all inflationary, right? So how much of a concern is inflation for you?
It is a concern, not out that far. At the moment, inflation's behaved. It probably comes down a little bit more, but given all you just put on the table, and I agree with everything you said, it's likely inflation's going to move back up. You know, the Fed has this target of 2% inflation.
Yes.
We're closer to 3 than we are to 2. I don't think we'll get to 2 unless we have a recession, and the path of least resistance, if the economy stays good, will be for inflation to tick higher, and that will eventually bother the markets.
One investment for a long-term diversified portfolio, if we had to own just one thing in a long-term diversified portfolio, so you're assuming that we're already diversified into some of the things that you just talked about, what would you have us all own?
So you know my bias is large cap U.S. stocks. So I'm going to give you 3 that have the following characteristics: high earnings predictability, high earnings persistence, and good cash flow. Cigna in the healthcare area, Lowe's in the consumer area, the do-it-yourselfer, and I want to own a technology stock, and I'm going to say Qualcomm. It doesn't have as high as predictability and persistence as the others, but the stock's pretty cheap. It's come down a bit in the light of mediocre third quarter earnings, but I'd be nibbling away.
All right, 3-1 investments. It's a portfolio. That's
the theme is the important part.
Absolutely. Bob Dahl, what a treat to have you on WealthTrack again. Thanks so much. And you and I are going to have another conversation for yet another program coming up very soon about reflections on 20 years of WealthTrack and 40 plus years of you managing money. I'm looking forward to that conversation as well. Bob Dahl, thanks for joining us this week.
Hey, it's been a privilege.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is a familiar one to longtime Wealth Track viewers. It is avoid the underperformance trap. For decades, studies have shown that investors underperform the funds they invest in. It doesn't matter if they are active or passive funds. Morningstar's latest research bears this out once again. Over the decade ended in 2023, investors in aggregate earned an average of 6.3% annually, 1.1 percentage points less than the mutual funds or ETFs they own. And according to the intelligent investor columnist Jason Zweig at the Wall Street Journal, investors typically underperform their investments not just in mutual funds and ETFs, but in hedge funds and stocks as well. How to avoid the underperformance trap? Once you have chosen your funds, be patient, stay with them, don't trade in and out. It will pay off in the long run. Next week, Bob Dahl reflects on his decades of portfolio management, what works and what doesn't in radically changing financial markets. In this week's extra feature, how does Bob Dahl recharge and relax? We will find out. Please follow us on Facebook, X, and our YouTube channel. As always, thank you so much for being here. Have a relaxing weekend and make the week ahead a healthy, profitable, and productive one.